In this week's video, we'll review the latest charts to help us better understand the impact of inflation on investing and the stock market. This week's video is being recorded early in the session on Friday, December 10th, when the S&P 500 was up approximately 160 points for the week. That's a big change relative to a week ago. A week ago, on Friday, December 3rd, the S&P 500 closed 166 points below the recent high that was made on November 18th. This is a headline here from December 3rd, where my cursor is, a headline here from December 1st. As we've covered in past videos, one of the things that we want to keep an eye on when markets are weak are financial conditions or access to credit. This is the type of spike look here that we want to avoid. These shaded areas show recessions, economic recessions in the United States. The Chicago Fed National Financial Conditions Index, all things being equal, when you're above this horizontal line here, financial conditions are tighter or worse than average, and when you're below the line, they're better than average. So think tight, low trust conditions up here, think loose, high trust conditions where you're basically confident that you're going to get paid back if you lend money. These are the readings on your screen between 1971 and 2010. Thus, last week, what we didn't want to see is a look like this here. This is the financial crisis, or any type of spike like this. How did this chart look as of the close on Friday, December 3rd, when the market was still 166 points below the recent high? The answer is not all that bad. It really hadn't moved a whole lot. This is the reading after the close on December 3rd. Not particularly alarming. Similar situation with credit spreads. These are widening spreads here. This is the COVID plunge period in the S&P 500 back in 2020. So in the present day, this is the type of look that we would want to avoid. If we look at the same reading as of December 8th, you can see relative to this spike in fear that occurred during the COVID plunge in the stock market, really don't have anything like that here. We did get a little spike here as of last week, but then this week, this is this portion of the chart here zoomed in on the bottom, had a little bit of a spike in fear, but then it came right back down as of the close on December 8th. This looks a lot less alarming here relative to this. This slide was put together during Thursday's session. This is the Producer Price Index, a chart that we've covered in the past. And the thought on Thursday was, it's hard to make an argument that this look here in the present day, and this is the reading in October of this year, it's hard to make the argument that this is alarming given the fact that PPI rose from 1982 all the way into the year 2000 here. If we fast forward one day after the inflation report on Friday morning, this is the headline that we're seeing on Friday morning. U.S. consumer prices soared 6.8% in the past year, most since 1982. If you know your stock market history, it's very, very difficult to get too alarmed if the present day looks similar to 1982. This is the S&P 500 down here where my cursor's moving around in 1982. An 18-year secular bull market began in the second half of 1982, and the S&P 500 didn't peak until March of 2000. And notice here, during the financial crisis, the Producer Price Index is plunging. This is a deflationary look. Again, it's hard to make an argument that you would want this line to be moving in this direction. When it moves in this direction, you can see from this point here to this point here, really, really good things happen in the stock market. Obviously, if inflation hits levels relative to what we saw in the 1970s, and credit conditions started to tighten up as they did in the 1970s here, and unemployment started to rise as it did in the mid-1970s, our concerns would increase. But as we covered a few weeks ago, there are a lot of differences between the present day and the mid-1970s. Mid-1970s was really a supply shock. The present day It's really just the opposite. It's a demand shock. Demand for goods and services is so high in the present day that production is having trouble keeping up. This is a week ago. This is as of Friday, December 3rd. Again, this is being recorded on Friday, December 10th. This is NASDAQ new lows. This is a rare reading. This is a rare spike in fear or almost near panic that we saw a week ago. See, the level here actually exceeded the level back in 2009 near this major low here in the stock market. Last week's level was higher than this level here near a major low in 2015, 2016. Spike here, you can make an argument it's similar to this spike here. This is Christmas Eve 2018 in the S&P 500, and after that, good things happened. Similar situation here. Level not that much different relative to the levels that we saw near the major low in April of 2020 after the COVID plunge here in the S&P 500. A week ago, this didn't tell us anything other than to be open to the stock market rallying relatively soon. If we fast forward a week, or in this case, looking at data as of December 8th, we did get some positive moves short-term on some of these breadth readings. Here's the S&P 500 here where my cursor is. This is the COVID plunge. The percentage of NASDAQ stocks making new lows was above this green line here, and then it came down and tagged the blue line. Well, that happened near the major low in the S&P 500. It's a pretty rare move relative to looking backward to 2020. The only other time that we've gotten convincingly above the green line was last week in this period here. And like this period here, when we went from green to blue, eventually good things happened in the stock market. Here we get a little spike in fear. We go from green to blue. Eventually good things happen in the S&P 500 from that point, simply telling us to keep an open mind about better than expected outcomes walking forward. This chart doesn't predict anything. It simply helps us with probabilities. If we spike back up into this area here, and the present day chart starts to look more like this over here, our concerns would increase. That may happen soon, but it hasn't happened yet. Somewhat similar read here. This is data as of the close on December 9th. This is NASDAQ new highs minus new lows. This is the S&P 500 falling here in Q4 of 2018. So this move here is fear from here to here. This is the COVID plunge in the S&P 500. The move in the indicator from here to here is fear. And in the present day, not as sharp as this or this, but the move from here to here is also fear related or related to economic concerns and market concerns. In this case, when you recovered and moved from the green line back to the blue line, good things happened down here in the S&P 500. Similar situation here. When you recovered, moved from the green line back to the blue line, eventually good things happened in the stock market here. Similar pop back up this week from the green line to the blue line. If you want to take a pessimistic look, it is possible that this move here in the present day is similar to this bounce right here, or similar to this bounce back up into this area here. The difference is this level here and this level here, neither of them were able to make it back to the blue line as we did this week. Very, very similar concepts here. This is your fear look. This is your recovery look, going from the blue line to the green line. This is S&P 500 stocks, the percentage above their 50-day simple moving average. When we went from here to here, eventually good things happened in the stock market. Here to here, this was somewhat of a double bottom look. We had to do it one more time, telling us to keep an open mind about something similar happening in the present day. But eventually good things happened in the stock market. October of this year, we went from blue to green, and we just went from blue to green again, not guaranteeing anything. Just telling us, all things being equal, when you're down here, you'd prefer to see a move like this, this, or this. The significant and prolonged cases where we shift from volatility to ignore to volatility to respect occur during sharp declines or protracted bear markets in terms of duration. This is Dow Jones Industrial, new highs minus new lows. The S&P 500 peaks out here in March, but the Dow peaks here in January of 2000, and you can see the breadth indicator clearly rolls over. Similar situation, the S&P 500 and the Dow peak in October of 2007, and you can see the breadth indicator clearly rolls over. After the recent bout of volatility, do we have something like this in the present day or something like this? The answer is not yet. This is the reading as of the close on December 9th. Rather than rolling over, we're making a series of higher highs, and if we zoom in here, this indicator just made a new high on December 9th. This look here may change very, very soon, but it hasn't changed yet. Very, very similar situation here. NASDAQ 100 advanced decline line. This is the S&P 500 peaking where my cursor is. The beginning of the dot-com bust bear market, and really bad things happen in the stock market in this area here. Here's the peak in the S&P 500 in October of 2007 before the financial crisis bear market in the S&P 500. Indicator has a rollover look, a discernible change in character here, a discernible change in character in this area here. How does the exact same indicator look today? The answer is quite a bit better. This is the same indicator as of December 8th. If we zoom in, it's hard to make an argument that the present day here, Bollinger Band look and the indicator look, looks similar to this concerning period here or this concerning period here. I've covered this chart in the past. This is NASDAQ Composite Weekly. This is during the session on Thursday, December 9th. At that point, the NASDAQ was up over 4% for the week, and we had avoided this look that we talked about before. RSI getting down into this area here would be more concerning. This is the COVID plunge here in the NASDAQ. This is your Q4 2018 ruin your Christmas plunge here where we had a bottom on Christmas Eve. You can see RSI here and here looks discernibly different from anything that we've seen since the major low in 2020. This too could change soon, but it hadn't changed as of Friday, December 3rd, telling us to keep an open mind about better than expected outcomes this week. And given the fact that on December 9th, the NASDAQ was up over 4% for the week, from a probability perspective, that turned out to be helpful. Not making any predictions about what this chart's going to look like in the future. As always, we're trading the chart in front of us. If we morph into a look like this, we'll learn something. If we morph into a look like this, we'll learn something. And the same thing can be said relative to price in here and price in here. Here's the NASDAQ 100, a little bit narrower than the NASDAQ Composite Index, the 50-day in blue all the way out to the 250-day moving average. Last Friday here, when we saw this headline here, and earlier in the week we saw this headline here dated December 1st, it's very, very hard to make an argument last week that this trend had been damaged in any significant way. As always, we'll see how things unfold going forward with an open mind. You can pause your video player here, but this is pretty much a large cap relative to mid cap type look. The NASDAQ 100 would tend to be your mega caps in the NASDAQ. And since March of this year, the mega caps have been gaining on the NASDAQ, the broader NASDAQ Composite. Right now, this looks like a breakout above this multiple month period of consolidation, and on December 9th, it was holding. Similar situation here on December 9th, multiple month period of consolidation between growth and value. For now, the breakout's holding in a bullish manner. We'll learn something if the ratio moves down here, more importantly down into this area here. Like any breakout, the longer it holds, the more meaningful it becomes. Similar situation here, December 9th, intraday, growth versus value weekly. This is MACD, black above red. It's a good sign. And also black above the 0 line, good sign. This means our primary trend is up, and we're not even experiencing a counter trend move at this point. This would be more of your counter trend move. Look, where black drops below red. And this is a situation where the primary trend is in jeopardy of rolling over when black rolls down and below the center line here. The last thing the growth versus value ratio did using these ETFs here was make a new higher high in November. Hasn't really come close to making a discernible lower low in recent weeks. We would have to exceed this low here from October. Remember, a week ago, the S&P 500 was 166 points below the high that was made on November 18th, but the longer-term trend on December 3rd, the weekly chart, we were still well above an upward-sloping 200-week moving average. The same concepts apply to the broader NYSE Composite Index. Here's your recent bout of volatility in here. This is a lot different from what we saw over here. Here's the COVID plunge here. The S&P 500 peaks on February 19th, and you can see in 3 weeks, here's 1 week, 2 weeks, 3 weeks, we're flirting with that 200-week moving average, a flattish 200-week. Contrast that with this 3-week period, 1, 2, 3. This is last Friday, December 3rd here. The chart you're looking at is dated December 9th intraday. We're nowhere near this upward sloping 200-week moving average. Right here, your secular trend thesis is in doubt, in question. This is volatility to respect down here. Don't really have anything here this week that's telling us that the secular trend thesis is in doubt. Also noteworthy, what does the 4th week look like? In this instance, in the 4th week, you drop below that flattish 200-week moving average. That's in sharp contrast to what we have in our 4th week, which would be this high-low close bar where my cursor is. During the session on December 9th, the NYSE Composite, rather than plunging in the 4th week as we did here, was up 2.88%. You can see here, this is consolidation. This is indecisiveness in here. This is high conviction here. We are not in a high conviction market, which helps us keep an open mind about a wide range of outcomes on all time frames. This is the NYSE advanced decline line. Similar situation here. Here's your advanced decline line from November of last year into the spring of this year. This is high conviction. We are not in a high conviction situation. We're in a consolidation situation, and until we get some type of break to the upside, we really shouldn't be making any assumptions about what's going to happen, and as always, we should be taking it day by day with an open mind, and that's what we're doing here, even after the gains. This chart here, December 9th, this is being recorded during the session on Friday, December 10th, after the inflation report was released. Nothing new here, day by day, no assumptions. Here's another chart telling us to keep an open mind about worse than expected outcomes and to maintain our maximum flexibility. Here's your high conviction look from November into the spring of this year. Small caps IWM relative to TLT in the ETF world. This period here and this period in here where my cursor's moving around, so from here to say here, looks a lot better than this from this point A to this point B. It's possible this speaks more about small caps, but it's very, very difficult to say that the risk appetite for market participants is the same here as it was here, simply helping us with this bullet point, and this bullet point. The same can be said for stocks versus bonds. There's really no convincing resolution here on your SPY relative to TLT chart. And our rate of change on some time frames, so this would be 2 trading weeks, 3 trading weeks, this is 12 trading days, and this is 25 trading days. Some of these are still negative. If you're a stock market bull, you'd like to see this consolidation resolve more convincingly to the upside. That may happen very, very soon, but it hasn't happened yet. This isn't necessarily a bearish chart. It's a pay closer attention with an open mind chart. You can see it a little bit differently here. The look of the chart here in November, late November, where my cursor is, this looks a lot better than it does now. We had a bullish breakout here. We were above all of the moving averages. We had a tight cluster here. You can make an argument we've come back and tested this tight cluster area here, and so far we've passed. But still, this is indecisiveness here. You'd like to see the indecisiveness break to the upside. May happen very, very soon, but we just don't have it yet. From a bullish perspective, we also don't really have a deflationary fear spike here. This is your COVID fear spike here. This is IEF, intermediate treasury bonds, versus the S&P 500. The present day just looks a lot better than this over here. This is our monthly look. A week ago, things were very, very shaky a week ago, but we were still above that 10-month and 40-month moving average. If we fast forward intraday on December 9th, similar situation here. On December 9th intraday, we were up 123 points thus far in the month of December, and above an upward sloping 10-month and above an upward sloping 40-month. When your screen has red all over it and you're in big-time give-back mode and you have a headline like stocks plunge on December 1st, December 3rd, tech stocks are getting hammered again, the chart in front of us simply serves as a reference point. This is our reference point a week ago after the close on December 3rd. The S&P last Friday ended up rallying, closed down 38 points. We're hovering right around an upward sloping 50-day moving average. Hard to make an argument that this look here is nearly as concerning as the COVID plunge look here in 2020. If we fast forward to intraday during Thursday's session, December 9th, and when I'm recording this on Friday, the S&P 500 was up during the session on Friday. We'll have to see how we close. But after a couple weeks of volatility in here, December 9th, we were still back to a full-bore bullish look with price above all of the moving averages. The slopes of all of the moving averages are up. Blue, the fastest moving average, is on top, and silver, the slowest moving average, is on the bottom. Contrast that with the look during a bear market. This is the financial crisis bear market. This is a full-bore bearish look. Price is below all of the moving averages in Q1 of 2008. Blue, the fastest moving averages on the bottom. Silver, the slowest moving averages on the top, and the slopes of all of the moving averages are rolling over. And this is the morphing look between this point here when the market peaks and Q1 of 2008. That may happen in the present day, but we're really not close to anything like that happening yet. Leveraged loans here, credit markets, this is your concerning type of look over here. Really didn't have anything other than a consolidation look over the past week. Covered this in the past. This is TLT versus SPY. This is consumer staples, defensive stocks relative to the broader market, SPY. And this is the VIX divided by the S&P 500. S&P 500 peaks here, here, and here, and you can see this is a big fear spike, a big spike in fear, and a big spike in fear. How does the same chart, or charts, how do these charts look today? Quite a bit different. Hard to make an argument that the present day chart looks anything like this, or this, given the trend looking backwards. Here is almost the polar opposite, and still almost the polar opposite. And all of these charts are as of December 9th. We'll go through this quickly. If you want to see this in detail, you can find the November 26th video. Remember, we covered the shift between value and growth stocks and asked how did the stock market perform walking forward. And the answer was very, very well on an average and median basis, with some exceptions here heading into the COVID plunge. We also asked and answered these questions here based on a signal that we saw on November 22nd of this year. And the answers to these questions were summarized here. And again, you can pause your video player. The important thing in the present day was we also calculated the maximum drawdown in the non-COVID cases. So basically took out the concerning cases. And we covered this chart on November 26th. So these are the non-concerning cases. Here's your drawdown, drawdown. Here's a drawdown, here's a drawdown, here's a drawdown. So on November 26th, for the most part, we were still in non-concerning case territory. If we fast forward to the present day, we did overshoot that a little bit here. This is a week ago, December 3rd, but we've rallied back into this area here. Moral of the story here is, if you move back into this area here, which is quite possible, we're not predicting anything here, if we get back down here, 4,500, 4,480, 4,460, the longer we stay in this area, the higher the probability we're moving into these type of looks here that are more concerning from a risk management perspective. Right now, we look more like the positive cases with green boxes. It's a chart that we covered in the November 26th video. It's as of the close on November 26th. At that time, we said, sure, this is a little unnerving, but we haven't even retraced at this point 38.2% of this A to B move from the October low to the November 18th high here. Price also was above an upward sloping 100-day moving average in green, an upward sloping 150-day moving average, and an upward sloping 200-day moving average. How much damage was done to this chart if we look at it in the present day? The answer is not a lot. Ended up coming back somewhere between the 50% retracement here and the 61.8% retracement of that A to B move that we talked about on November 26th. So this would be point A, the November low. This would be point B. Thus far, this looks like a normal retracement of this rally here. Concerns would increase if price moves down into this area here. The longer it stays there, the more concerning it would become. The VIX really speaks to volatility expectations. Here's the spike in fear and volatility expectations in February of 2020, the initial COVID scare over here. We did get a similar spike recently, but unlike this period here where the VIX kept rising and never came anywhere near this gap. We didn't come back to this gap here until August of 2020. We came back into the same gap and closed it within several days. Here's the chart of the VIX on December 9th intraday. Once again, the chart in front of us has calmed down. Concerns would increase if the VIX goes up here and makes a higher high, and more importantly, prints a higher closing high above this high here. How about the longer term themes? This is stocks versus bonds. Think SPY divided by TLT in the ETF world. This is your peak here, late 1999, the year 2000. Here's the line here. We're above that line on December 8th, telling us that this long-term period of indecisiveness and consolidation that dates all the way back to 1999 may be ending. And this speaks to the probability of stocks outperforming bonds, as they did in a significant manner from 1982 into the spring of 2000, where my cursor is. And we know this still holding the bullish breakout look that we have on December 8th also aligns with the demographics. And notice, the demographics that we're talking about also align with that 1982 period that we discussed in the opening segment of the video. This is a headline dated Friday, December 10th. Notice it mentions 1982. 1982 is in the relatively early stages of this secular trend here. Hard to make an argument that inflation in 1982, which is similar to the inflation today, was bad for stocks on a long-term basis. Here's a chart that we covered in recent weeks. U.S. financial conditions are still very, very easy And that's the same type of look that we're getting from credit spreads and the Chicago Fed's National Financial Conditions Index. This is a big tailwind here for stocks. Thus, is inflation something that should be on our radar and something that we should be concerned about? Absolutely, positively, yes. It could be a problem. But we have to remember what we're seeing in the present day is quite a bit different from what we experienced from, say, 1969 to 1975. It's also good to keep in mind, if we start to look like the 1970s, so if the unemployment rate starts to rise, that would be one red flag. Stocks did not perform well in that period, but there are some significant differences between the present day and the mid-70s. Remember early in the video we showed this, new lows. This is a weekly chart. New lows on the NASDAQ composite, and said this is a pretty rare fear look here. If you look back to 2009, you really don't see spikes this high very often. And many of them came very, very close to major lows in the S&P 500 index. So this is basically a form of sentiment. This is high and extreme fear about future economic and market outcomes. We also had something very, very similar to that last Friday on December 3rd when the chart was down here. This is intraday on December 3rd, the S&P 500. We were down 68 points a week ago intraday. Again, this is Friday, December 10th, intraday when we're recording this. So this tweet here, you can pause your video player. In terms of put options volume, fear up here is really not all that much different than fear here in the early stages of the COVID plunge. So options activity is highly fearful a week ago today. Price action over the past 4 weeks here, the chart in front of us, looks discernibly different from this 4-week period here where options activity was showing high levels of fear as well. You may remember last week we went through somewhat of a pro and con look on December 3rd, and we said last week we had seen signs of distribution or institutional selling, and that our volume and breadth data was decidedly concerning and bearish and lopsided, and that we hadn't seen anything yet to offset these concerns. If we fast forward a week, that's no longer the case. As we noted on Twitter earlier this week, we did see some very, very encouraging and strong, almost mini breath thrusts in the market. So this tweet here where my cursor is related to this tweet here, both of them from December 7th. You can pause your video player and read this here. This big drop in the VIX is also relevant. A very, very similar situation to December 3rd a week ago. There's nothing really particularly alarming on this chart on December 9th or December 10th relative to the longer-term trend and the longer-term secular bull thesis. But it's also fair to say we're not in a high conviction market at this point, which is good news. Because we all know the only way that any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.